Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, that's where I dive deeper into all this stuff. Looking for investment opportunities, sharing it with everybody, answering your guys' questions on the weekends, and interacting with everybody through a midweek update and a Q&A session on the weekends. So if that sounds interesting, if you really like investing, want to learn about it, definitely try it out. Special is the coupon code. It works both on the monthly and yearly memberships. All right, Michael Kramer, look at copper. Big move lower, 20% lower. That's what happens when people start to mess with tariffs on, off. Who knows? You get these big selling pressure moves. Now, is the move done in copper? I don't think so. And I'll show some data down below of a longer term fundamental picture of copper. So I know the short term can be, we'll say it, big gyrations of price movements. But I don't think that the overall big trend in sector fundamentals, nothing's ruined. So yeah, they're pulling levers here, and I hope they're not doing insider trading on this. I really hope they're not doing stuff like that. That would not be very ethical. But a big move with the announcement of some copper products not being included. Coming down, shabam. He says American crude oil exports are at their lowest 4-week average in the last 3 years as tight inventories equals lower crude availability for export. With rigs and frac fleets dropping continuously, expect to see further pressure on America's ability to feed the world's demand for crude oil. Look at that. That's a dive bomb there a little bit, isn't it? A little bit of a dive bomb going on there. So the 4-week average U.S. exports, we had a pretty big bump higher in 2015 of exporting our lighter crude oil. But now we're coming back. Looks like we peaked in 2023 or so. We've pulled back substantially. Substantially. This is from Miles Franklin Precious Metals here. Billionaire Ray Dalio says investors should allocate 15% of their portfolios to gold or Bitcoin to hedge against rising government debt. The founder of hedge fund firm Bridgewater Associates warned that the U.S. is nearing a point of no return, with a potential fiat currency devaluation similar to the 1930s or 1970s. Dalio strongly prefers gold, citing its role as the second largest reserve asset globally, though he still holds some Bitcoin. Dalio made the comments on the Master Investor podcast. Is the debt crisis about to force a reset in the global financial system? And this is total public debt going vertical. So, I mean, 15% of someone's portfolio should be in gold. We can't even do that, guys. 15% of everyone's portfolio held in gold would just, at the current price, it's impossible. We would need the price to go up ludicrous amounts. I mean, if everyone bought 2 ounces of silver just in America, you'd buy almost the entire production of a single year of silver. There is so much currency out there. I mean, there is so much currency. So I think what they want people to do is they're trying to herd the cats into Bitcoin. That's what I think they're trying to do. They're trying to herd everybody into Bitcoin and other cryptocurrencies because it's intangible. It can soak up an infinite amount of liquidity. And then they're going to devise schemes of how they're going to backdoor treasury bonds through that liquidity going into intangible assets, I think. I think that's what they're trying to do. Keep this whole system going. But yeah, you can't have everybody at 15% put their money in gold at 15%. I mean, the price would go like astronomically higher. I mean, we couldn't even like see. I mean, that would be like multi-$100,000 gold, maybe even more than that, depending on if America or the entire world does it. If the entire world does it, I don't even know where the price of gold would be if everybody put 15% allocation to it. U.S. implied jet fuel demand, products supplied in million barrels per day. That's way up there. Look at that thing. That's a spike and a half. We're outside the cloud, boys. We're outside the cloud. We've been living outside the cloud. Look at this. March was up there. April's up there. May. Hey, no demand. No flying demand here, right? That's way up. James Harvey. So this is the fundamentals on copper. Copper, the metal powering the future. By 2050, annual copper demand will surpass all copper consumed between 1900 and 2022 combined. Combined. So all of the copper that we have mined from 1900 to 2022 will be consumed in 2050. That's ridiculous. That is ridiculous. Because today we're at 26 million metric tons. I think that's what that is. But projections show demand soaring to 53 million metric tons by 2050, driven by electrification, EVs, renewable energy, and global infrastructure growth. Copper demand has doubled roughly every 25 years, fueled by major supercycles. The Industrial Revolution, post-World War II boom, China's industrial rise. Now, the transition is set to create the next supercycle. For investors, miners, and policymakers, this is more than a trend. It's a structural shift. The race for copper resources will define the next 3 decades. So here's copper. In 2050, annual copper demand will be greater than all copper consumed from 1900 to, so from here to here, this 1 year will consume more copper than all of this combined in that one big year there. That's crazy. Absolutely crazy. The question I have is, do we have it? Like, can we flow that amount of copper in 2050? If we can't, what does that mean? What does that mean? What does it mean if we can't even flow in like late 2020s, early 2030s? If we can't flow that amount of copper, what does that mean for the world? Are we going to try to come up with substitutions? Is graphene going to be substituting copper and aluminum and all these other minerals? We have a solution? I don't know. Is artificial intelligence going to come out and try to figure out solutions for this? You know, I was listening to artificial intelligence. I think it was by Tom Bialu, and I was just listening, and there's some pretty big expectations around AI and the abilities of AI and how fast artificial intelligence will grow and change our world. In that case, wouldn't all wealth be commodities and energy? Because artificial intelligence would basically level the playing field. Like it would just level everything out of all companies. Like there wouldn't be companies. It'd be like AI, and you'd say, hey, build me this design to build XYZ. But if you owned all the materials on Earth, at least, that's where all the wealth would be. It's in the energy and it's in the commodities itself. Now, can it figure out, and they're talking about ridiculous levels of how smart AI could be. So it would have to reconfigure potential, I mean, not just designs, but maybe even make exotic materials, stuff that we can't even fathom. I mean, at that point, is investing cooked in its entirety? Like, there'd almost be no reason to even invest because, one, you can't even imagine if it were to get to that level, you couldn't even understand or imagine the things that this thing could do. It'd be outside of everyone's capabilities. And who knows what that world even looks like. So right now, I don't know how fast it's going to change the world. I was just making a comment because I listened to some of his stuff last night. this is copper demand going up. So we've got a whole bunch of demand. We want to most likely transport electricity, use it in electric vehicles, use it in all this electric world. I'm wondering if that world will even transpire. Are we even, do we even have the correct projections? Or is this all going to change? And if you come into this world where AI is dominant, let's just say, wouldn't you want to own a bunch of energy and a bunch of commodities? Because what it's essentially doing is flattening all of industry and replacing humans that do that work and shrink manufacturing lead times to basically nothing. So if you can get products from design to manufacture with basically, zero time, then you need to have an infinite supply of energy and an infinite supply of commodities to configure whatever AI can design. So that's the interesting thing. And then what are people going to do? Are they just going to sit at home? Or are they going to go party like it's 1999 and just go drive around everywhere? I don't know. And how can people afford that? It's going to be an interesting future. Marco Kolanovic, he was a JP Morgan guy, I think, an analyst. He says data centers may end up being the biggest misallocation of capital in human history, bigger than even windmills. Trillions to tweak order of video in Reels or SPY or spy on you to better target ads. So he's not as bullish on it. And I like having people, both sides of it. And, Tom, he's saying it's like going to change the entire world massively. And Marco's saying this could be the biggest misallocation of capital. I mean, what about two different sides of the story here? I'm not sure what will come about, but I'm going to keep going with what's cheap. And data centers and or AI, I think they're going to consume a lot of energy, irrespective. And if I can go buy energy companies that are at basically all-time lows on, like oil to gold ratio, uh, coal to gold ratio, like all these different ratios they're basically at all-time lows. I can put trades on at all-time lows with the upside that they're going to use a whole bunch more energy. If they don't use a whole bunch more energy and it's a big bust, well, I mean, I still bought it at the bottom anyway. So that's kind of how I view it. I like this quote here, guys, because there's too much logic behind it. Bitcoiners claim that housing is so overpriced now due to the liquidity credit bubble that boomers will never be able to sell their houses because no one is stupid enough to pay those prices, while also claiming someone will pay millions of dollars for their magical tokens one day. I hate to say it, but that is the most logical thing I've heard today. And when I read it yesterday. No, I read that today. It was today. So they claim, oh, how is anybody ever going to afford, a house? They can't sell houses. Nobody can afford it. But yet people are going to pay millions of dollars for a magical coin. A string of zeros and ones in hexadecimal format that we can recreate for pennies on the frickin' ten thousands of dollars. Yes, makes no sense. IEA predicts fastest rise in power demand in more than a decade. Fastest rise in power demand. But you go look at the gold to oil ratio, go look at coal to gold ratio, even natural gas. Cheap, 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 and cheap. If we're going to see the fastest rise in power demand in more than a decade, I think that's a good spot to park some money. I think that's a good spot. Why? Because I can put the trade on or the investment on when it's the cheapest it's ever been in history at the same time that we're seeing the fastest rise in power demand. Perfect. I'm in, baby. Let's ride this thing. Novelism says you get paid for being right first and to be first. Can't wait for consensus. So this is what people do wrong. They wait for this consensus. They wait for it to come out in the news. Can't do it that way, guys. I'm sorry. It just doesn't work. you can't use news as a validating factor. In order to be first, you have to look at the charts. You got to get in at a very cheap location. Uh, you can use ratios that will tell you when something's really cheap, and that's generally the best time to accumulate, is when something is off the page cheap. So that's how you can be first. I just gave you an option of how to do it. Use ratios. You can use technical analysis combined with ratios to increase your probability of success, and hopefully it can reduce the holding time where it starts to pay out quicker. But if you're going to be first, you're going to have to, you're showing up to the party first. No one's there. It might be boring for a while. You might have to sit, twiddle your thumbs, drink a couple of drinks by yourself. But when the party comes, that's when it's going to pay off. ANZ, strong cooling demand amid higher than normal temperatures across Europe, is having an impact across the energy space. Coal prices have bounced off of 4-year lows as countries scramble to produce additional electricity for citizens. So there's the bottom in April, May, and we're starting to head higher. We can see this in the charts of the companies. They're putting in double bottoms and breaking out and all sorts of stuff. Now, Gary Savage, he says, virtually all countries and empires collapse for the same reason. The lure of free money from the printing press seduces politicians into giving away more and more free stuff to buy votes. The debt perpetually spirals higher and higher. At some point, it starts to create inflation, which also ignites the war cycle, and interest payments on the debt starts to strain government's ability to service the debt, forcing more printing and more inflation and more printing. An inescapable death spiral. The only escape is eventual default and a depression to cleanse the system. This, of course, is devastating for the middle and lower class. Those most clamoring for the free stuff, little do they know, they are sowing the seeds of their own destruction in their quest for a free lunch. Think about that for a second. Warren Buffett, the best way to minimize risk is to think. How do you minimize risk? Well, think. Come up with solutions. I think not adhering to emotions too. A lot of FOMO buying is pretty risky. U.S. annual electricity demands at all-time highs. Look at this thing break, guys. We got a little resistance level through here, and it's breaking out to the upside. U.S. electric loads were stagnant during the 2010s, but are growing again due to technology companies building data and computing capabilities. Here we go, starting the big move. Cody Sanchez. So this is her opinion. Buying assets, hard assets, before GPT, which is the GPT is your AI kind of typing crap in, deflates our pay and ownership becomes concentrated in the hands of the few, is like getting on the last lifeboat off the Titanic. I think it only is hard assets. I don't even think you can buy, like, most of these companies, like, if AI really takes off the way that they are projecting, and I'm not projecting that, I'm just saying it's a big if, okay? So let's say if it does. Well, then health insurance companies, they're gone, because how are people going to afford health insurance? How are people going to afford anything, really? And if these companies take off, how how are the companies going to sell anything to people who aren't making any money? Like, is it the chicken and the egg thing? Like, we just put fictitious money into the hands of people and then they just cycle it through companies? I don't know. It seems kind of weird. And hard assets would be the only thing that works, because a company, if AI is that good, then all companies would essentially be bankrupt, because the speed at which AI would innovate would bankrupt all the current companies. So you just open up and everyone would open up a company through AI and say, make me this thing. But if you own the energy and the commodities to make those things, then that's what you're paying for. You're paying for the ability to obtain certain commodities and energy products and combining them using AI for final use products. And AI would come up with everything. It would come up with the materials to use, the energy. It would consume energy doing it, but materials to use, the energy, the equipment, all this other stuff, and then essentially it would be the business. And the business or AI would essentially make the person, the owner, all the stuff that they need. 3D printed or whatever the heck it comes up with. It's probably something even more advanced than 3D printing. I don't know. The commodities, so this is Grady. The commodities bull market will be the greatest opportunity in your lifetime to get out of the rat race. Every parameter I can think of is in place for the greatest bull of all time. End of rainbow stuff. Maximize income, minimize consumption, and play it the right way. Now, I see these charts just like he does. It's like everything is turning in favor of commodities very slowly on these big long-term charts. Ratio charts against technology, the S&P 500, and then it's in all of the commodity charts like silver, gold, copper. They're all starting to turn against these big indexes and stuff. So is that being driven by a normal cycle, or is it being exacerbated by artificial intelligence that's coming and the need for more commodities, more energy, more electricity, more everything? I don't know, but I just know we need to be there. That's kind of what I see in the charts and the big long-term cycles, saying we need to be here. And is it driven by debt too, which I think it is, the debt problems. Freight futures AM update, dry bulk, Capesize, Panamax both up 1%, and then tankers, VLCCs up 1, Suezmax down 1. Another one from Grady says, do not get beat down by the declines or lose interest during them. Understand them, be ready for them. They will pass. And do not fight the market. Use that energy to improve emotional control. And always, always know the big picture. It's still on track for gold to continue up. Could we go sideways for a little bit? We could. We'd still be in the big move. So again, this is the possible time span for the fifth A wave to top, the third bull move, somewhere between 2027 and 2039. If it's right translated, then we top beyond 2028, which would be very reasonable for this bull market. And if we top in 2034, if the fifth K wave is similar to the fourth K wave, that's what we're seeing there. This one's from Jordan Roy. We'll talk about this. The bull market in gold did not begin in 2016 or 2018. Let me explain why gold, silver, and hard assets are in a new secular bull market that will run well into the 2030s, which is similar to what Grady's saying. So let's go. Hard assets make their major moves after the end of a secular bull market in equities. The stock market remains in a secular bull, right at this time. It remains in a secular bull at this time. After the S&P 500 peaked in 1929, gold stocks peaked 8 years later. After the secular peaks in the S&P 500 in late 1968 and early 2000, gold, silver, and hard assets peaked 11 years later. Bonds just fell into a secular bear market a few years ago. The last secular bear in bonds lasted roughly 17 years. Here's some of the data that he's using for the S&P. Every 11 years there, bonds heading lower. It's a peak and a peak here in the 1960s. And then there's gold, buy points. or high points, I should say, not 5 points, high points. He says, within the secular trend, capital herds in one or two of the major asset classes of stocks, bonds, and commodities, which I totally agree with. Stocks and bonds trended together in the 1980s and 1990s and 2010s, while gold and bonds trended together in the 1930s and 2000s. Gold and hard assets were all alone in the 1970s. He's talking about money rotation here. This could repeat in the 2030s. The current secular bear in bonds will lead to the end of the secular bull in stocks, as was the case in the mid to late 1960s. I'm going to repeat that real quick. The secular bear in bonds, increasing interest rates, will lead to the end of the secular bull in stocks. He nailed it. And that happened in the mid to late 1960s. That will open up even more capital for gold, silver, and hard assets. There are periods of overlap, and we are in one of those periods. Stocks and commodities overlapped in the 1940s. Stocks began a new secular bull in 1942, and commodities were finishing their secular bull, leading to the peak in 1951. Stocks exploded after 1949. Today is much like the 1960s, when some forms of hard assets begin a new secular bull, while the one in stocks was approaching its end. Capital will move out of stocks and into commodities when the secular bull in the stock market ends, and it will end sometime soon or in the next few years. That capital will move into another asset class. Because bonds are already in a secular bear market, that capital will move into gold and hard assets. As many have pointed out, Bitcoin and crypto is a leveraged play on the tech sector. Moreover, it's been running since 2011 and is a mature secular trend like stocks. Agreed. Implied allocation to gold remains very low. Adjusting for the rising price of gold, the nominal assets in gold ETFs remain below 2020 and 2011 highs. In real terms, as seen in the image below, the implied allocation to gold via ETFs is near secular low. We haven't come off the bottom yet because people are remaining in the stock market and crypto markets. But that's going to peak at some point, and then all of that money is going to go away from bonds, away from stocks, into precious metals and hard assets. It's coming. Gold versus the S&P 500 secular move started a few months ago. So we're right at the beginning of this. The chart below plots gold against the S&P 500 dating back 170 years. The previous secular peaks in the ratio were nearly 5 during the Great Depression and nearly 6 in monthly terms in 1980. The present ratio is 0.52. That means that we could 10x plus this ratio. This level is not even a fraction of where it will peak. Moreover, gold's rise against the stock market has barely started. Gold had surged higher to new all-time highs by 72, 73, but its ratio remained near its secular low. It had another 7 years to rise. See the thin vertical line there. The thin vertical line is here, and we had a big move higher still to go at 72, 73. And now we are at a ridiculously low ratio. We have a long, long, long way to go for gold to appreciate against the S&P 500. Gold backing of U.S. monetary base. Gold at its current price multiplied by U.S. gold reserves backs 15% of the monetary base. At 100% backing, the gold price would be $21,000 an ounce. And there is the ratio of gold backing to the monetary base. We are way low. We're lower than 1970, the beginning of the bull market last time. And we're gonna end up rotating money into this. It's gonna be a big, big move coming. And you have to be patient enough for this stuff to rotate around. U.S. gold reserves as a percent of the Fed's balance sheet. Great chart from here. Similar to number 6, it's a few months old but makes the same point. There you go, super cheap. Summary: gold, silver, and hard assets made secular peaks in 2011 and 1980. Each was 11 years after the secular peak in the stock market. The stock market has yet to make its secular peak. When it does, and because bonds are already in a secular bear, there will be nowhere for capital to move but into hard assets. That's the capital rotation. Various charts and data show gold's secular move began in late 2023 or February of 2024. So that's where all this is at. We're right at the beginning of gold outperforming the S&P. We need the S&P and NASDAQ to peak, basically, and get that full capital rotation coming our way. But that's where we're going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And that's all I've got for today. So we'll catch you next time. This is Finding Value.